Listen carefully, because what I'm about to share could affect your retirement plans, your monthly income, and the lifestyle you've worked decades to build. I'm Larissa, and I've spent the last 15 years helping seniors understand their legal rights and financial protections. Today, I'm here to walk you through the most important Social Security changes coming in 2026. Changes that every American senior needs to know now, before it's too late. A few weeks ago, I sat down with a client, Margaret, 72 years old, a retired school teacher. She came to me in a panic, holding her Social Security statement. She said, "Larissa, I don't understand. I've been planning my retirement for years, and now it looks like everything might change. How will this affect me?" Her worry wasn't just about numbers. It was about security, independence, and peace of mind. Margaret's story is not unique. Millions of seniors across America are feeling anxious because Social Security isn't what it used to be, and misinformation is everywhere. The letters from the Social Security Administration can be confusing. The news reports can be misleading. And some well-meaning friends may even offer advice that's outdated. But here's the truth: you don't have to feel helpless. You have rights, and with the right information, you can make the changes work for you instead of against you. So let's start at the beginning. What exactly is changing in 2026? First, there's a major adjustment to the cost of living increase, or COLA. In simple terms, the government adjusts Social Security payments every year to keep up with inflation. But in 2026, that adjustment is expected to be one of the largest in years, which is good news for your benefits. But it comes with a catch. If you don't understand how this works, or if you make a timing mistake when claiming your benefits, you could leave hundreds or even thousands of dollars on the table. Here's an example. Last year, a widow I worked with, Helen, 75, waited until her birthday to claim her Social Security increase. But she didn't realize that claiming later in the year could reduce the retroactive payments she could have received for the earlier months. By asking the right questions and planning carefully, we were able to adjust her claim and maximize her payout. That's exactly what I want to help you do. Avoid mistakes that could cost you money unnecessarily. Next, the rules around taxation of Social Security benefits are also changing. Many seniors don't realize that if your income crosses a certain threshold, a portion of your Social Security can be taxed. In 2026, those thresholds are shifting. For some, that could mean paying more in taxes. For others, it might be an opportunity to plan withdrawals or manage income strategically so that you minimize what goes to Uncle Sam. Now, here's something that often surprises people: your benefits could also change depending on your spouse's work history and earnings record. If you're married or widowed, understanding how your spouse's benefits interact with yours can make a significant difference. I recently helped a couple, Robert and Janet, both in their late 70s. By carefully analyzing their Social Security statements, we found a strategy that increased their combined monthly benefits by over $400. That's not pocket change. That's a small extra vacation every month, or extra money for medications, groceries, or hobbies that bring joy to life. So, why am I telling you all this? Because Social Security isn't just a check in the mail. It's the backbone of your retirement security. And changes like those coming in 28 or 26 aren't just numbers. They can impact your life, your independence, and your peace of mind. But here's the empowering part: with the right knowledge, you can plan, protect, and even increase your benefits. Before we move to the next section, I want you to do something. Take out your Social Security statement, or log into your My Social Security account online and look at your monthly benefit. Notice your full retirement age, your current earnings record, and your spouse's information if applicable. Keep that information handy because, in the next part, we'll break down the 5 specific changes in 2026 that could directly affect your monthly payment, including who gets more, who gets less, and how to avoid mistakes that could cost you thousands. Remember, this isn't just about numbers. It's about your security, independence, and dignity. If anything I'm saying feels familiar, if you've been worrying about your Social Security or wondering whether you're making the right choices, you're not alone, and you're in the right place. Stay with me, because the next section will make things crystal clear. We'll go step by step, story by story, so you can see exactly how these changes work and how to make them work for you. And as always, if you hear something that applies to your situation, jot it down or share it with someone you trust. Your peace of mind is worth it. Now, let's get into the specifics. In 2026, there are 5 major changes seniors need to know, and today we'll focus on the first 2. By the end of this section, you'll know exactly how these adjustments could affect your monthly benefits and your retirement planning. The first major change is the cost of living adjustment, or COLA. As I mentioned, COLA is designed to help your Social Security payments keep pace with inflation. In 2026, COLA is projected to increase more than in recent years, meaning your monthly benefit could go up significantly. But here's the important part many seniors overlook: timing matters. Let me give you an example. I recently met with George, 74, a retired firefighter. He assumed that COLA would automatically show up in his bank account without any action on his part. But because he delayed signing up for supplemental Medicare benefits tied to Social Security until mid-year, he inadvertently missed out on several months of additional COLA payments. After reviewing his case, we were able to appeal and recover a portion. But the lesson is clear: knowing how the adjustment works and when it applies is key to maximizing your benefits. Here's a simple tip: mark your calendar when Social Security announces the annual COLA increase, usually in October. Check your benefit statement immediately and compare it to the prior year. If you notice discrepancies, reach out to Social Security promptly. Acting quickly ensures you don't leave money on the table. Remember, COLA isn't just a number. It's your financial breathing room, your cushion for rising costs like medications, groceries, and utilities. The second major change involves the taxation of Social Security benefits. This is where confusion often hits hard. Many seniors think Social Security is untouchable by taxes, but in reality, depending on your income, a portion of your benefits could be taxed. In 2026, the income thresholds that determine taxation are changing, and for some, this could mean paying more, or less, than they expect. Take Janet, 71, a retired nurse I recently worked with. She had been working part-time and earning a modest pension, but with the new 2026 rules, part of her Social Security benefit became taxable. Initially, she panicked, worried she would owe hundreds in taxes. But by reviewing her combined income and carefully timing withdrawals from her retirement accounts, we were able to strategically reduce her taxable income, keeping her benefits mostly tax-free. That's the power of planning ahead. Here's what you need to know. Your Social Security benefits are taxed based on your combined income, which includes wages, pensions, interest, and 50% of your Social Security benefit. The thresholds for 2026 are slightly higher, meaning some seniors who previously paid taxes may now see relief. But for others, it could increase what they owe. The key is understanding your total income and how it interacts with Social Security. Don't wait until tax season to figure this out. Planning now can save significant stress and money. The actionable step for you today is simple. Pull your last year's tax return, your Social Security statement, and any other sources of income. Make a note of your combined income and project what it will be in 2026. If it crosses the new thresholds, consider strategies like delaying withdrawals from taxable accounts, taking advantage of deductions, or consulting a financial professional. Every move you make now can protect your income and keep more money in your pocket. These first two changes, XULA adjustments and taxation rules, might sound technical, but they are directly connected to your financial security. Miss them, and you risk losing out on money you worked decades to earn. Understand them, and you can plan with confidence. In the next section, we'll cover the third and fourth major changes, including adjustments to spousal and survivor benefits and early retirement penalties. These changes are especially important for married couples, widows, and anyone thinking about claiming benefits early. I'll also share stories from clients who avoided costly mistakes by knowing exactly how the new rules work. Before we move on, I want you to pause for a moment. Open your Social Security statement and look for these sections: your current benefit, XOLA history, and your combined income for taxation purposes. Take a moment to see where you stand today. Doing this now will make the next section much easier to follow and could save you a lot of stress and confusion in 2026. Remember, Social Security isn't just a monthly check. It's your lifeline, your independence, your ability to live comfortably in retirement. Understanding the changes before they take effect is the first step in keeping control of your financial future. So far, we've covered the cost of living adjustment, XOLA, and changes to taxation rules for Social Security in 2026. Now, let's dive into two more critical areas: spousal and survivor benefits, and the often overlooked early retirement penalties. These changes may seem complicated, but with the right guidance, you can turn them into advantages rather than pitfalls. Let's start with spousal benefits. Many seniors aren't aware that their spouse's work history can affect their own Social Security payout. In 2026, the rules around how spousal benefits are calculated are changing slightly, particularly for couples where one spouse delayed claiming their benefits past full retirement age. This change could mean higher benefits for some couples, but only if they plan carefully. I recently worked with Linda and Tom, both retired. Tom had a long career with Social Security, covered employment, while Linda spent years as a stay-at-home parent. Before 2026, Linda could claim spousal benefits as soon as she reached age 62, but by doing so, her monthly amount would have been permanently reduced. With the upcoming changes, we were able to advise Linda to delay claiming just a few months past her full retirement age, which resulted in a larger lifetime payout, enough to cover several months of her yearly expenses without touching their savings. Here's the takeaway: if you're married or widowed, don't automatically claim the first benefit you're eligible for. Take the time to understand how spousal and survivor benefits interact. Small adjustments in timing can add hundreds of dollars to your monthly check and even thousands over your retirement. Speaking of widows and widowers, let's talk about survivor benefits. This is one area that can be emotionally charged and financially confusing. In 2026, rules around survivor benefits are being adjusted slightly to account for inflation and changes in average life expectancy. That means your surviving spouse could receive a higher percentage of the deceased spouse's benefits, but there are conditions you must meet. Take Margaret, a 73-year-old widow I recently advised. She thought she had to claim survivor benefits immediately after her husband passed away, but she didn't realize she could delay her claim strategically. By waiting until closer to her full retirement age, Margaret was able to increase her survivor benefit by over $200 per month. That's a significant difference for groceries, utilities, or even healthcare expenses. Here's what you should do. Check the date your spouse passed away and your current age. Look at the full retirement age for survivor benefits and compare it with early claiming options. Sometimes waiting, even for just a few months, can maximize what you receive for the rest of your life. Don't let fear or misinformation rush you into a decision that could reduce your financial security. Now, let's talk about early retirement penalties, because this is where many seniors make costly mistakes. In 2026, the penalties for claiming Social Security before your full retirement age remain in effect, but subtle adjustments mean that miscalculations can result in lost benefits over your lifetime. Many people assume they can claim early and catch up later, but the math doesn't always work that way. I once met Harold, 68, a retired truck driver. He wanted to retire early, thinking he could take his Social Security at 62 and then increase it later by delaying other benefits. Unfortunately, he wasn't aware that claiming too early permanently reduces monthly payments for life, and the early retirement penalties can wipe out the increases he hoped for. We ran the numbers together and found a better claiming strategy that allowed him to access some benefits early, but still maximize his lifetime income. Here's the simple truth. Claiming Social Security early is not inherently bad, but it must be strategic. Age, work history, spousal benefits, and survivor benefits all interact, and missing even a single detail can cost you hundreds every month. That's why planning now, before 2026 takes effect, is so important. Actionable step for you today. Check your full retirement age. Look at your spousal and survivor benefits. Run a rough projection. What would your monthly check look like if you claimed early V's waiting? Consider speaking to a professional or using Social Security calculators online to see the long-term impact. The bottom line is this: Social Security isn't just about collecting a check. It's about strategic planning to protect your financial future. Small decisions now can make a huge difference in 2026 and beyond. In the next section, we'll cover the fifth major change for 2026 new rules for delayed retirement credits and benefit maximization strategies. This is where seniors often miss out on hundreds, even thousands, of dollars if they don't know the updated rules. I'll also share another real-life story of a client who avoided costly mistakes by taking the time to plan carefully. So stay with me. Your future self will thank you. And remember, understanding these rules isn't just about money. It's about peace of mind, independence, and dignity in retirement. So far, we've explored CALA adjustments, taxation changes, spousal benefits, survivor benefits, and early retirement penalties. Now, let's tackle one of the most powerful strategies for increasing your Social Security income in 2026, delayed retirement credits, and how to maximize your lifetime benefits. Delayed retirement credits are often misunderstood, even by seasoned retirees. Simply put, if you wait beyond your full retirement age to claim Social Security, your benefit grows by a certain percentage for each month you delay, up until age 70. In 2026, these credits are slightly adjusted, meaning the longer you wait, the more your monthly benefit increases, but only if you claim strategically. Let me tell you about Walter, a 70-year-old retired electrician I recently advised. He assumed that claiming at full retirement age was good enough. But after reviewing his record, I showed him that by delaying just a few months, his monthly payment would increase by over $250. That's $3,000 more per year. A significant boost for medications, travel, or simply enjoying retirement without worry. Here's the key insight: delayed retirement credits are additive. Every month you wait past full retirement age increases your monthly benefit. But there's a catch. If you start taking benefits too early, you permanently lose part of that potential increase. That's why understanding your personal situation, including income, health, and life expectancy, is critical. Another common mistake seniors make is not coordinating benefits with their spouse. If you and your spouse both qualify, the timing of your claims can impact the total household income dramatically. For instance, one spouse can claim early while the other delays, creating a strategy that maximizes combined lifetime benefits. I worked with Patricia and John, a couple in their mid-70s, who initially planned to claim at the same time. After analyzing their benefits, we recommended John delay claiming while Patricia took hers early. This simple adjustment increased their total lifetime income by more than $50,000. That's the power of strategic planning. Next, let's talk about a mistake I see too often: assuming Social Security claiming is a set it and forget it process. Many seniors don't realize that rules change annually. What worked for someone last year might not work in 2026. Small details like changes in COLA, taxation, or spousal benefits can significantly impact what you receive. Not keeping up can cost you money that you may never recover. Here's an actionable step: review your Social Security statement today. Compare your current benefit, projected COLA, delayed retirement credits, and spousal benefits. Identify if there's an opportunity to delay strategically, or if claiming early might actually be the smarter choice based on your circumstances. Knowledge is power, and in this case, it's money in your pocket. Finally, let's address the emotional side of delaying benefits. Many seniors hesitate because they think, "I've waited long enough. I need the money now." I understand that feeling completely. But consider this: delaying can provide financial security that lasts a lifetime, not just a few months. One of my clients, Carol, 68, initially felt anxious about waiting. But after running the numbers, she realized that delaying even 6 months meant an extra $150 every month for the rest of her life. That extra security allowed her to focus on enjoying retirement rather than worrying about bills. In summary, delayed retirement credits can significantly boost your monthly benefit, but timing is crucial. Coordinating benefits with your spouse can increase total household income. Rules and projections change, so staying informed is essential. Emotional concerns are normal, but planning strategically ensures long-term peace of mind. Next, we'll pull everything together. I'll give you a complete step-by-step action plan for 2026, including tips for maximizing your benefits, avoiding common pitfalls, and making confident decisions about when and how to claim. You'll leave with a clear roadmap, so Social Security works for you, not against you. Before we move on, take a moment to reflect on your own Social Security strategy. Are you maximizing delayed retirement credits? Have you coordinated spousal or survivor benefits? Are you prepared for the 2026 changes? Write these questions down, because in the next section, we'll answer them all in a practical, actionable way. Now it's time to bring everything together and create a step-by-step action plan for 2026. This is about turning knowledge into action so you can protect your income, maximize your benefits, and safeguard your peace of mind. Step 1. Review your Social Security statement carefully. Start by logging into your My Social Security account online, or pull out your latest statement from the mail. Look at your current monthly benefit, your full retirement age, any spousal or survivor benefits, your combined income for taxation purposes. Highlight areas where changes in 2026 might affect you. COLA increases, new taxation thresholds, and delayed retirement credits. This is your financial snapshot, the foundation of every decision you make. Step 2. Project your income. Look at all sources of retirement income: pensions, part-time work, investments, and Social Security. Calculate your combined income and compare it to the new 2026 taxation thresholds. If your income exceeds certain levels, part of your Social Security benefits may be taxable. Knowing this in advance allows you to plan withdrawals strategically or make adjustments to minimize taxes. Step 3. Coordinate spousal and survivor benefits. If you're married or widowed, this step is crucial. Review your spouse's benefits and explore strategies to maximize household income. Ask yourself, should one spouse claim early while the other delays? Is delaying survivor benefits the better choice for long-term security? Are there opportunities to increase lifetime payouts by waiting even a few months? These questions might feel complex, but careful planning now can add thousands of dollars to your lifetime benefits. Step 4. Decide on timing for delayed retirement credits. Delayed retirement credits are a powerful tool, but only if used strategically. Determine whether waiting past full retirement age will significantly increase your monthly benefit. For example, even a delay of 6 months to 1 year could boost your income substantially over your lifetime. Factor in your health, life expectancy, and financial needs before making a decision. Remember, every month counts. Don't claim early out of habit or fear without checking the numbers. Step 5. Avoid common mistakes. Some of the most costly errors seniors make include claiming benefits too early without considering lifetime impact, ignoring spousal or survivor benefits, overlooking taxation thresholds, failing to account for COLA adjustments, not keeping updated on 2026 rule changes. By staying informed, asking questions, and planning carefully, you can avoid these pitfalls. Step 6. Take action now, don't wait until the last minute. Use the knowledge you've gained to make intentional decisions. Contact the Social Security Administration if you have questions. Use online calculators to model scenarios, and consider consulting a professional if your situation is complex. One small step today, reviewing your statement, running a calculation, or setting a reminder, can protect thousands of dollars in benefits over the years. Let me share a story. Marjorie, 76, came to me confused about her Social Security benefits. She had received multiple letters and wasn't sure what to claim first. By taking these steps, reviewing her statement, projecting income, coordinating with her spouse, and delaying strategically, we increased her monthly income by over $350. That's $4,200 a year she would have otherwise missed. More importantly, she gained peace of mind knowing she made an informed decision. Remember, Social Security isn't just a check in the mail. It's your financial independence, your ability to cover expenses, and your security in retirement. Changes coming in 2026 may seem complicated, but they are manageable when broken into clear steps. Finally, here's my encouragement to you: you have the power to protect and maximize your benefits. Knowledge is your best tool. Take action early. Ask questions. Don't let fear or confusion make decisions for you. You've worked your entire life for this moment. Don't leave money or peace of mind on the table. If you take just one thing from this series, let it be this: review, plan, and act strategically. Social Security can work for you, but only if you understand the rules, claim at the right time, and coordinate your benefits wisely. Before I go, here's a practical challenge. Take 30 minutes today to review your Social Security statement. Note the key areas we discussed: COLA, taxation, spousal and survivor benefits, early retirement penalties, and delayed retirement credits. Write down one change you can implement immediately to maximize your 2026 benefits. And if this series helped you, share it with someone you love, a spouse, sibling, friend, or neighbor. Your knowledge could save them thousands of dollars and provide peace of mind in their retirement years. I'm Larissa, and I'm here to make sure you understand your rights, make informed decisions, and protect what you've earned. Social Security changes may be coming, but with the right strategy, 20s and 26 can be your most secure year yet.